It's time for the midweek check-in here on Stonkcast, folks. We got Magnificent 7 earnings to get into from Wednesday, the Fed rate decision, some new tariff news. Plus, of course, I'll be breaking down the latest with Opendoor. We had a reverse stock split that got postponed from Monday. We'll break down the latest with that and two very important reasons I believe you should remain very, very bullish on Opendoor. Stick around for all that and much, much more. As always, make sure to like, subscribe, and follow wherever you listen to podcasts. And now, folks, let's get into it. Welcome back to Stonkcast, the market show for the average Joe. Whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host as always, Brandon Shar. Welcome back, folks. And before we jump into it, we are very excited to announce that we're going to be releasing a new premium investing service over the next couple months. If you're interested in investing for the long haul, we did put out a free video series a couple months back on the Intelligent Investor written by Benjamin Graham. Basically, the foundation for everything Warren Buffett has done, but we're going to be bringing to you a premium tracker for that value investing updated for current inflation, bond rates. We're going to be updating it monthly. Basically everything that we gave free a couple months ago, but we're going to be updating it regularly. So if you are interested in that, make sure to check out the link in the description and sign up. So when we are essentially ready to drop it, you're the first to get notified. All right, so let's jump into basically how the market did on Wednesday. First of all, taking a look at the S&P 500. So these are the Fibonacci extension levels that I've been talking about for a while now, and it's pretty wild how these actually work out. So if we take a look at Wednesday, we came down to the 50% level on this Fibonacci extension, tapped it, and then came back up. But if we take a look intraday at a 4-hour chart, or actually let's drill down even more. Let's take a look at the 15-minute chart from Wednesday. This basically tells the story. It was a very choppy morning, and then we got the Fed rate decision. We got Jerome Powell talking, and things kind of tanked from there. We attempted to recover some of it, but as you can tell, the afternoon itself was pretty wild indeed. And as of right now, like I said, we're holding above that 50% Fibonacci extension level that we, got through last week. It's showing as support, and as always, like I've been saying, my next target for the S&P 500 right now, 64.67. So a little bit of a pullback from the all-time highs, and we're going to get into some of the reasons for that. Taking a look at the the tech heavy NASDAQ via the Qs, and basically the same story, kind of a indecision day, but holding above all major moving averages, of course, so that's always great. And then taking a look at the Russell 2000 via the IWM, this one broke below the 20-day moving average today. It was down 0.5%. Small caps had a really challenging day. And then taking a look at the VIX had a spike up to 17, basically when we got all that news from Jerome Powell, and then came off a little bit, closed at basically 15.5. Quick check-in on Bitcoin at time of recording, sitting at 118,000, just above it, up 0.2% right now. This is TradingView. If you are looking for a new trading platform, this is one that we trust here. Make sure to check the link in the description. You can get $15 off. So as of right now, we're kind of consolidating, and for a while now, I've been saying I think we're just kind of forming a bull flag, a bull pennant on Bitcoin, and it seems that's exactly what we're getting right now. We got the all-time high at 123, and we'll see if Bitcoin can break out. But as of right now, I think it's holding up pretty well given all the volatility we saw on Wednesday in the afternoon. So some of the reasons that we saw some of that volatility on Wednesday, first of all, this from CNBC, Trump says Friday tariff deadline will not be extended. President Donald Trump said that he will not extend the deadline for his reciprocal tariffs on dozens of countries to restart. Trump has previously claimed that he would not extend a deadline on those tariffs before going on to do just that. Trump has issued letters to more than 24 countries setting new tariff rates on their goods starting in August. So obviously we got a deal done, last week we talked about with Japan, but we still have some countries that we don't have deals with. Most importantly, I would say China. And so it seems right now that there isn't going to be an extension. Deals need to get done or else. He's going to start slapping, tariffs on everything. On Wednesday, we saw President Trump slap a 50% tariff on copper, and we saw a lot of copper-related companies tank hard off of that. And so I would venture to say we're going to see some more pretty aggressive tariff rates getting slapped on this weekend as that deadline approaches. But hey, it's President Trump. He's a wild card. He could always change his mind, so we'll see what happens there. Now let's move on to some Magnificent 7 earnings that came out. And the reason we focus, look, we're in the middle of Q2 earnings. There's a lot of earnings happening right now, but the Magnificent 7 are the earnings that I think we need to be paying attention to because the Magnificent 7, folks, accounts for about 30% of the S&P 500. Pretty significant. So first of all, let's take a look at Microsoft. Microsoft tops $4 trillion in market cap after hours, joining NVIDIA an exclusive club. Microsoft shares jumped in extended trading on Wednesday, pushing the company's market cap past $4 trillion. The software giant reported better than expected quarterly results and said Azure's annual revenue topped $75 billion. That's insane. NVIDIA became the first company to reach the $4 trillion mark earlier this month. So if we do a quick check-in on Microsoft, this thing absolutely exploded on Wednesday in after hours. And if we just do a quick check-in on an hourly chart, you can easily tell here for those on YouTube, this thing exploded, folks. It had the dip down intraday when we had Jerome Powell basically selling off the whole market. And then in after hours, we got the earnings and it skyrocketed from about 510 all the way up to 562. Massive, massive move for Microsoft, and they just continue to kill it. Another big Magnificent 7 company that reported earnings on Wednesday was Meta. Meta shares climbed 10% on revenue beat raised forecast. So shares of the social media company jumped more than 10% after the company reported second quarter earnings on Wednesday that beat on revenue. Meta said third quarter sales will come in the range between $47.5 billion and $50.5 billion, ahead of Wall Street estimates of $46.14. The company said capital expenditures will come in between $66 billion and $72 billion, raising the low end of the company's previous estimate of between $64 billion and $72 billion. So all you need to know, Microsoft, Meta, both crushed it. Meta was pretty wild. Closed Wednesday at 4 p.m. right around 700, skyrocketed to 781 in after hours trading. That is insane. So for any of my degenerates out there that bought some calls on Meta or Microsoft before the bell, you had a nice little dip due to the tariff news, and you got a nice ripper in after hours. So congratulations. But that's good news for the overall market, and it's part of the reason why we saw the futures markets, doing so well Wednesday evening. You had the NASDAQ futures up over 1.25%. You had the E-mini S&P 500 up 0.8%. So, things are looking good in the futures, at least at time of recording here, because of the fact that you have two very, very, very large companies, Meta and Microsoft, doing so well. So that's great to hear. Now let's move on to the Fed rate decision that we got on Wednesday. This, according to CNBC, divided Fed holds key interest rate steady, defying Trump's demands for aggressive cuts. The Federal Open Market Committee voted 9-2 to keep the federal funds rate set in a range between 4.25% and 4.5%. The decision was met with opposition from Governors Michelle Bowman and Christopher Waller, both of whom have advocated for the Fed to start easing. This was the first time since late 1993 that multiple governors cast no votes on a rate decision. President Donald Trump has been pushing the central bank to cut the benchmark rate. During a news conference, Powell said the FOMC hadn't yet made a decision, about what they would do at a September meeting. So we came into Wednesday knowing exactly what was going to happen as far as the Fed fund rate. We knew it wasn't going to move. We knew it was going to remain where it was. But what the market really wanted was some dovish tones from Jerome Powell, aka Daddy Powell, for September. Because again, we don't have a Fed rate decision in August. We have to wait a couple months. We're going to get one in September. But he didn't really give us anything. He didn't tell us, that they were going to cut rates. He didn't say they weren't. He just basically said that there was going to be no decisions about September. As this article says, markets had overwhelmingly expected no action on rates, but stocks headed lower after Fed Chair Jerome Powell said at a news conference that the committee hadn't yet determined whether it would cut rates as its September meeting. We have made no decisions about September, said Powell. We don't do that in advance. We'll be taking that information into consideration and all the other information as we make our decision. So they're basically going to get 2 rounds of data, 2 months worth of inflation data, right? And employment data to make their decision off of. But he didn't really give us any indicators as to whether or not we're going to get a cut in September. So, President Trump was not happy about that. And the way the market reacted after 2:30 p.m. when, Jerome Powell started talking, the market wasn't happy about it either. And if we take a look at the CME FedWatch website here, for the odds of a rate cut, 25 basis point cut in September, it has dropped significantly. Basically, a month ago on June 30th, you had about a 75% chance of a rate cut. 1 week ago was 59%. 1 day ago was 63%. And now it's only 42%. So as of right now, it's basically a coin flip whether or not we're going to get that first cut for 2025 coming in September. That Fed rate decision will be September 17th. So a lot to keep tabs on there as far as the Fed rate goes. The market didn't like it. They don't like not having certainty. They don't like that, Jerome Powell didn't give us any indication as to whether or not we were going to get that. But hey, that's where we are and we have to take it where it is. So moving on to some key economic data. Obviously, we've had a lot coming out this week. We had JOLTS coming out on Tuesday. Wasn't too hot. We had ADP non-farm employment change. That was good. GDP was good. And then the Fed rate decision stayed the same. Nothing crazy there. Looking at Thursday and Friday, you get core PCE data coming out. So that's the Fed's preferred inflation gauge. So that's going to be 8:30 a.m. Eastern. Initial jobless claims, Chicago PMI. And then Friday, August 1st, we're going to get average hourly earnings month over month for July, non-farm payrolls, and employment rate, ISM manufacturing PMI. A lot of data coming out over the next couple days still. So really this entire week has been jam-packed with economic data, major earnings, a Fed rate decision. There's been a ton going on. And it's not over yet, folks. We still got a couple days. So we'll see how the rest of the week shapes up. And now let's move on to Opendoor. So one of the things that we talked about in our last video, if you haven't seen it already, make sure to go check that out from our market prep session on Sunday. We talked about the fact that there were 2 important dates that we needed to be paying attention to for Opendoor. The first one was going to be the reverse stock split decision that was set to come out this past Monday. And then the second one was the August 5th earnings that are coming up. And so on Monday, we got news from Opendoor that they were essentially postponing the reverse stock split vote. So this, according to Yahoo Finance, dear Opendoor stock fans, mark your calendars for August 27th. Opendoor shares remain in focus after the digital real estate platform delayed a shareholder vote on the previously proposed reverse stock split until August 27th. The management's decision to postpone the shareholder vote comes on the heels of a meme stock rally that pushed Open shares well past $1, restoring compliance with the Nasdaq's minimum listing requirements. So as we've talked about before, one of the reasons why they even brought this proposal up in the first place is the fact that they were trying to remain compliant on the NASDAQ. In order to do that, your stock essentially has to be trading above $1. And at the time of that initial proposal where they were talking about, voting on this reverse stock split, they didn't even have that. And now they do. So I find it very, very interesting that they decided to essentially postpone this, and I'll get into, some of my reasoning about that here. But as this article lays out, is it a positive for Opendoor stock? Regaining compliance with the Nasdaq's minimum listing requirements is a positive signal for Open stock, primarily because it eliminates the immediate risk of delisting, which could have triggered forced selling. Moreover, delaying the reverse split demonstrates management's confidence that the stock can recover organically, protecting existing shareholders from dilution. This perceived stability enables Open to focus on operational execution and capitalize on bullish momentum. So, I thought it was very interesting when the news came out Monday that they were postponing this to August 27th. So keep in mind, you get earnings on August 5th. So if you're in management's position and you're postponing this till after your earnings, to me, what that indicates is really twofold. First of all, it indicates that, hey, we feel good about our earnings that are going to be upcoming. We feel good about the position that we are in. I think if they felt vulnerable based off of their earnings on August 5th, they would be more inclined to go ahead and vote on the reverse stock split because they're assuming they're not going to be able to remain compliant. However, that's not what happened. They postponed it after their earnings. So I thought that was very interesting. And then secondly, as the article said, I think it really just puts investors in a position where they can be a little bit more confident in Opendoor and Opendoor's management. This is basically a subtle nod from the Opendoor management to really the retail community that says, hey, we believe in this rally. We believe that we can back up these price movements in our stock. And therefore, we're going to hold off on this vote. And the company's already made it very clear that they don't want to dilute their shares. They don't want to do a reverse stock split. And they don't want to artificially pump up their stock price that way. They want to keep things the way they are, essentially. So this is very interesting. So it's now been pushed off to August 27th. For me, as someone who has a position in Opendoor, I feel very confident in the fact that we didn't vote on the reverse stock split this past Monday, but instead the fact that they're postponing it. Now, with that being said, they could still vote to approve it. It doesn't mean they have to utilize it, right? I think they have until November or something like that. So there's a chance that this still gets approved, but I think it is a positive sign, right, for investors that instead of just voting on it in the moment, they decided to push it off. It's a nod to the retail community. It's a nod to the recent frenzy in Opendoor. It's showing us as investors in Opendoor that management recognizes what's happening and they have confidence. So I think that's a big, big, big deal. So, and if we take a look at Ape Wisdom, just to get an idea of, hey, is it still trending on Wall Street Bets in the past 24 hours? Obviously, right now, the big deal is Meta, which is bumped up significantly, and Microsoft, obviously, because of the great earnings that they had. And as of right now, Opendoor has slid down a few spots. It's currently at number 8. It's still in the top 10, which, in my opinion, means it's still relevant. You can look on various platforms, such as StockTwits. I like to use Webull. In the Webull community, Opendoor is still a top 5 in popularity as far as the ranking. So it's still getting traction is what I'm trying to say. And I also love just following Eric Jackson and some of his posts. It's just great. It's great entertainment. He's basically the roaring kitty of this Opendoor movement, in my opinion. I love this one here. Let's go. Nobody cares. Work harder. So true. And then this was an interesting post from Eric Jackson. The Bloomberg consensus revenue estimates for Opendoor. So this is the Bloomberg consensus for Open. 2026, $5.75 billion. 2029, $12 billion. So at 4 to 5 times forward enterprise value divided by revenues, where relevant peers trade, 2025, right now, instead of $2 a share, he's saying the fair value is really $31 a share. 2028 fair value, $82 a share. So based off Bloomberg consensus revenue estimates for Opendoor, he is getting these numbers. just kind of continuing to lay out his argument from a fundamental standpoint why he believes this company is insanely undervalued right now. And I have to say, the more I look into it, the more I agree with him. Of course, drop a comment, let me know what you think. If he's wrong, entirely off base. But as of right now, it seems to make sense to me the more I look into it. So, and also an interesting thing here as well, he dropped, this tweet. Basically, these are the 100-bagger. This is his 100-bagger track record over the past 15 years. So he basically just listed out all the companies that he was on before they exploded. I mean, you got Alibaba here. It was private at $10 million in 2009. Obviously, that company is insanely valued now and thriving, doing great. He picked the Microsoft CEO 6 months prior. I mean, you got Roku on here, Carvana, of course, Coinbase, Uber. I mean, numbers don't lie. I mean, he's definitely called a few 100-bagger companies. Now, he's also the first to tell you that he's also been wrong on certain ones as well. He was on Opendoor a little too early based off of what he said a couple of years ago. But all that to say, if you look at his track record, the guy is definitely on to something, folks. And so based off of that and based off of the interest in this from the retail community, based off the short interest, which continues to be insanely high, above 20%, I think we got something cooking here, is all I'm saying. So let's take a look real quick at the chart for Open, just to kind of see how the week has looked. Now, keep in mind, as I've said before, we have some Fibonacci retracement levels that I've been paying attention to based off of the 51-cent low that we had back in late June, and then the high that we had the other Monday, where we went up to 497 on that insane volume day where we were up 120%. Based off that, you have some key retracement levels. And I talked about in the last episode how really the battle at the 61.8% retracement level was going to be huge. The $2.21 level. That was going to be a big kind of line in the sand, if you will. And just below that also being $2, a more psychological level. And that's where we're at right now. So even though we got the reverse stock split postponed until the end of August, the way Opendoor has traded this week has been in such a way that investors are, kind of nervous about the fact that we postponed it because there's still uncertainty. I think if we had the vote on Monday, you would at least know which way it's going to go. But the fact that it's delayed, I could argue is the bullish thing, as I've said earlier, because I believe the company has confidence in the company, right? But on another side of the coin, it can be viewed as more uncertainty. And we've talked on the show many times about how the market in general doesn't like uncertainty. So basically we have, the bears have been in control this week, basically. So we opened right around 270 on Monday. We got as low as just about $1.88 on Tuesday. And then on Wednesday, we tried to reclaim 221. And so right now we're kind of in this, what I call the golden pocket, if you will. It's basically the space directly underneath the 61.8% retracement level. And sometimes stocks do not just simply, tap a Fibonacci level. They work incredibly well. But sometimes they kind of trade right around it, right? And so this is a range that I'm looking at. It also happens to line up with $1.50. If all else fails and we can't hold $2, we could easily retrace down to $1.50, which is right around where the 20-day moving average is. But one of the interesting things from a technical analysis standpoint, one of the things that I think is kind of bullish and something that I take confidence in is the fact that we have basically stepped in. Buyers have stepped in anytime the stock has gotten close to or below $2. So if we take a look at Tuesday, we broke below $2 briefly, and then we managed to climb back up. So yes, we did get below $2, but then buyers stepped in, and that shows confidence at that $2 level. It shows value at that $2 level. Same thing happened early pre-market overnight from Tuesday into Wednesday. got down to $1.91. It got bought right back up. And then off the open, we defended it again, which I would argue is more important when you defend a price level in regular trading hours versus after hours where, there's not a lot of volume happening. But anyways, we shot up to 221 to that 61.8% retracement level. And as you can tell here, Fibonacci levels work great because that ended up being what was support turned into resistance on Wednesday. And so as of right now, 221 is really the new level of resistance. And we headed off into the market close on Wednesday right around 208. So as of right now, we are holding above the $2 price level, which I believe is still very, very important. I think and I think I've said this before, but in my opinion, the very, very short term outlook for this stock in particular, if we get below $2, the bears are taking over. Just to put it frankly, I don't want to give any false hope. This is just my own opinion, of course, but I think if we get below $2, I think we lose a lot of momentum. We start to see volume die off. But if we are able to hold above $2, this could be the new support level, and then really looking to recapture 221, 250, 274, 3. Those are the levels that I'm looking at. But basically, we had some consolidation between 274 and 221 last week. Now we're down to this new level here, and let's see if $2 can hold as the new support. Now, with all that being said, one of the interesting things, if we go back to a daily chart here on Opendoor, basically the stock has been cooling off. And I've said this before, basically when you get these massive moves in a short squeeze where a stock goes up 100, 120%, like we saw Opendoor do a couple Mondays ago, that isn't sustainable, right? You want to see some consolidation. You need to cool off a little bit. And we basically have been doing that, which is fantastic. If we take a look at the RSI, the Relative Strength Index, this is a momentum indicator. It is great to use for momentum plays, which is exactly what Opendoor is right now. It got as high as 95 on that Monday when we shot up to almost $5. And so if we look at where we are trading at right now on Opendoor, right, which is right around $2, currently the RSI is at 59. That is not bad at all. If we compare it to when Opendoor was at $2, basically the other week, right before the massive run up. So this was on Friday when we were right in the $2 range. The RSI at that point was at 90. So we've gone from $2 being 90 on the RSI to $2 being 59 on the RSI. That is cooling off. That is resetting the momentum. And that is exactly what we need in a healthy way in order to get another leg up. So really what I'm hoping for here is just to build a base at $2. I want to see some consolidation. And then, of course, try to make a retest of that 221 level. So we've seen the volume kind of dip down a little bit, especially on Wednesday. It was about half the volume we had on Tuesday. And so that could be viewed a couple different ways. That could be momentum dying. That could be the selling pressure kind of subsiding or drying up. Time will only tell. But again, I think $2 is really the line in the sand right now. And so as far as one of the most important reasons why I remain bullish on this, all you have to do is look at the options chain. If we take a look at Wednesday, folks, keep in mind, just take a look at this chart. We've gotten beaten up since the run up to almost $5 a couple Mondays ago. This thing has been resetting and there's been a lot of profit taking, a lot of selling. Despite all of that, folks, we have a put to call ratio from Wednesday sitting at 0.33, meaning there are 3 times more calls than puts being bought right now. That is an extremely bullish sentiment on Opendoor. On Wednesday, we had over 278,000 calls versus only 93,000 puts. So that is very, very significant in my book. Typically, when you look at a chart like this, where you're seeing a lot of recent bearish action, you would expect a more even distribution between calls and puts. The fact that we have such a heavy leaning towards the call side shows me and tells me that there are a lot of people out there, whether retail or institutional, we don't know, that are very, very bullish on this company. And the interesting thing too is our IV percentile, which was upwards of 100%, meaning 100% of the time, the implied volatility is lower than it currently is in the past year, which means you don't want to be buying premium there because it's the highest it's ever been. It's basically come off quite a bit, and the current IV percentile is now sitting at 49%. So that's a huge drop in the implied volatility. It is making being a buyer of premium, whether calls or puts, a lot more attractive. And so I just wanted to quickly look at some of the monthly expiration dates just to see what kind of strikes are currently showing unusual open interest, right? Because that can be an indicator where people think this thing could go. So if we look at the August 15th monthly expiration, as of right now, we got over 44,000 contracts of open interest sitting at the $5 strike on the call side. So there's a lot of people betting that this thing can get to $5 by August 15th. That is very interesting. You also got over 47,000 at the $6 strike. So you got 5, you got 6, you even got 24,000 up here at $9.50. Those are more lotto bets, but still very interesting. You got 36,000 sitting at $3, 33,000 sitting at $3.50. So a lot of open interest, folks, sitting on the August 15th monthly expiration for Opendoor. And if we compare that to the put side, as far as, some of the open interest here, it's not really the same. You got 67,000 sitting at $2, but $2, that is, the $2 strike price. But beyond that, everything else is pretty minimal. You got 2,000, 3,000, 1,000. So definitely a lot more calls being bought than puts. And then one more interesting thing that I found here, if you go out to the January 16th, a ton of open interest on the call side here as well. Over 63,000 contracts of open interest sitting at the $5 strike price for Opendoor for January 16th, 2026. Over 39,000 open interest sitting at the $7 strike. So again, there's a lot of open interest sitting on the options chain right now for Opendoor. And I think that is very, very notable. It's something that really piqued my interest when I looked at it today, because I assumed it would be more distributed between calls and puts. So basically what that tells me is if we can hold two, if that options chain continues to look the way it's looking, we could be in a gamma squeeze kind of scenario, because keep in mind, all those calls are being bought, but who is selling those calls? More than likely it's market makers, and market makers have to remain net neutral. So as those contracts get more favorable, as the delta changes on those contracts, as the price moves up closer to those strike prices or even in the money, you're going to have market makers that need to remain net neutral. And the way they do that is by buying shares, right? And so they literally pour on gasoline to the fire of those contracts that they wrote. And so that in a very simplistic format is what you would call a potential gamma squeeze. And so if we can hold two and that open interest remains there, I think we could be setting up for something very, very nicely. And oh, by the way, earnings are August 5th. This is expected to be Opendoor's first positive EBITDA report in over 3 years, which is basically just saying if you strip everything away and you just look at earnings before you take away taxes and other things like that related to the business, they are going to be showing signs of being a profitable company. So definitely have that on your radar. August 5th, it's Tuesday, I believe, coming up very, very soon. And we will, of course, be covering more of Opendoor as we get closer to that earnings report. And we will see what happens, folks. So we got 2 more days left in the week. We still got some key economic data coming out. We'll see how Opendoor wraps up the week. We'll see if we can reclaim 221, 250, and see if we can gain back some of that buying volume that we saw from the other week. So as always, I appreciate the support. Make sure to subscribe. Make sure to leave a comment. Let me know what you're feeling about Opendoor. If you got into any of the Magnificent Seven plays with the run-ups that they had with earnings, whether it was Meta, Microsoft, keep in mind that we still have some earnings coming up towards the end of this week. Real quick, just a breakdown of that. So Thursday, we got some more big hitters coming out. You got Apple, you got Amazon after hours, more of the Magnificent Seven there. And then you got ExxonMobil, Chevron on Friday. But really, those are the two big ones to be paying attention to on Thursday after the bell. You also get Coinbase in there as well and Reddit. So just a few names to be paying attention to. So again, thanks as always for the support. I will be back as always for the market prep video on Sunday. Thanks, and I hope you enjoy the rest of your day. And as always, folks, remember, plan the trade and trade the plan. Have a good one.